Craig.
Todd, I am so excited. Our first podcast was a hit, and we're back for some more.
Sounds good.
What has changed since we had last had our podcast?
You know, it's interesting, at least interesting to me. When we last met, it was just after the California fires in Eaton and Palisades. And there was kind of a thought process that might have some effect on rates and availability of reinsurance. And there's just a tremendous amount of money still flowing into the marketplace. A lot of pressure on rates, which means there's pressure on coverage in the commercial insurance market. And even with, we're currently in a bombing situation in Iran and what's going on in the Middle East and this closed down the Strait of Hormuz, there's still thought that there's still a lot of cash still looking for investment in the commercial space. That has also bled over to the residential space on our reinsurance side. And so that pressure on valuation, the pressure on adjusting the valuation has actually increased. After the fires, there really weren't as many catastrophic losses in the U.S. The hurricanes all missed Florida. And so there's real pressure to get more premium on the books. And they're doing that by cutting values.
And do you think that any of that could be avoided if, let's say, carriers took action years ago with correct valuations or leveraging a tool like yours to be able to pretty much prepare for when something does go wrong?
I think the key to it, and we work with a lot of brokers and the reinsurance broker side, and what they're doing, just making sure they understand what's there. And then you can make a plan. And so I think your point about it is, I think that would make an effect because it just compounds over years. If you get a great number, and you know where you are when you look at your portfolio, and then you can take advantage of those market changes over the years. If you're a little behind the curve, you're always behind the curve. So even though you're lowering rates, you're lowering coverages, you're already at a very low level. We work with a couple of clients that, they really want to get the most insurance to value that they can. They're walking the line between that and losing the revenue side of it. But they want to understand which risks they're going to take and which risks they're not going to take. And again, if you have a great portfolio, you've maintained it over the years, I think you're in a better spot to be able to pick and choose what you're going to write and not write and still make money and still grow.
And you said something that was interesting to me was that if they were behind the curve, then they're going to stay behind. And what can a company do to really make a jump or take a sacrifice, maybe increasing rates to get ahead of the curve in the most strategic way possible?
Well, and we've had discussions. A number of our clients have gone into what I would call a distressed carrier. And they've gone in, took a look at where they were writing the coverages, what they had on their books, and they cut their way to growth, which sounds, counterintuitive to other companies. And we've, folks that we knew reached out to them and said, how'd you do this? But you can actually, by cutting 50 or 60% of what's on your book, cut your way to growth because you can then write on your terms. You can get rid of what was causing a lot of the losses and the bleeding of the premiums and to get your premium right as you go forward, get your rate right. So it's not the premium as much as the rate. I got the right rate for the exposure. And so it can be as drastic as getting rid of half of your book, which does cause some agita for some people. But 2 or 3 years later, these companies have demonstrated they continue to have great capacity, they continue to get capacity at a great rate, and they continue to grow and grow profitably.
And I think that a huge component to it is that it's not just so much as providing a tool, rather than it is having that experience that you have to walk a carrier through that type of program or revision or that type of process to ultimately make sure that they feel comfortable with what's going on and to get them back, I guess, online, right?
Yeah, and I think it's, because people always say, well, that's an opinion. You have an opinion of the value of that property, whatever, and that is correct. That is an opinion. But if you have a consistent and standardized approach, you have a consistent and standardized opinion, I think. And I think that's where we can, provide the ability to level set, and you got to benchmark, and you can benchmark to it year after year, and that really helps you build that capacity, I think.
What would be the first actionable steps that you can take an organization through when implementing E2Value?
So we always recommend we run the book, we level set the book, can see what's going on. Now, one of the things that we've work on, it's not just what we know, but if you talk to actuaries, you can demonstrate it. 5% of most books are responsible for 40 points of your loss ratio. And so part of that exercise is to find that 5%, because that's the one that's going to be notoriously underinsured, stuff that was put on the books when it shouldn't have been, maybe. The second part of underinsurance is underinsured properties tend to have multiple losses. So you can look it up. It's like, and I don't know, it's a 30% or 40% chance that they're going to have more than one loss. So they have the initial loss and then more losses. And it's an indicator of what type of business your producers, the line of folks that are giving you your business are putting on the books. And then you can figure out a plan from that. But you start with the portfolio review, and if everything's a bell curve, right? And if you take the idea that the top end of the bell curve, that there's 0 or 0.5% or 0.25% of overinsured properties, because I don't think there's a lot of overinsured properties. And you go through the bell curve, that means there's a lot of underinsured properties on the other side of that bell curve. So the stuff in the middle is going to be okay, but it's those tails that cause all the trouble. And the tails can really, bury a company. And that's why when we do the portfolio review and we look at the, that we're trying to find that 5%, and that's the key to be able to turn a book around or get a handle on your book.
And providing this level of a solution and understanding, like what's the reassurer's takes on this, and how do they support? Do they feel indifferent? Because ultimately they are here they want the company to succeed. They want to protect them. And with your capabilities and your understanding, you're really able to help the reassurers, not just necessarily the carriers.
And that's really where you see it. We just had 2 portfolios come across our desk last week where the reinsurance carrier was dictating to everybody that their insurance to value is way too low, that they need to bump up their insurance to value. And they were using what I looked at was more of a property value, a real estate value of the portfolio, but they were still looking at it and saying, we think you're underinsured. So the carrier took action, did some reviews, and they can take action going forward. And I think from the reinsurance standpoint, what we see is they may not be telling the carrier that they're underinsured or they have a largely underinsured book, and they're then charging more. They're making their own adjustments to it because it's their money that's in the reinsurance side. And they're definitely making adjustments to the portfolios, whether the carrier knows it or not.
So if the carrier were to correct itself and get online, it actually, not only would it help with their replacement cost valuations, it would also help with their reassurer.
Number one thing, it's going to help with your reinsurance. But even before you get to the underinsurance and paying the claims and all that, if you have a grip on your portfolio, the reinsurance companies will recognize it. And that's what our clients have seen. They've seen the recognition of understanding what's on the book, understanding of, inflation factors to that book. So we were talking back, like we said, if you had to do a reestablishment of value, that's going to play well with the reinsurance side of it. And if you're in the excess surplus lines, just getting capacity, getting someone to support your program, that's another important part of that.
Now, and we spoke about levels on our last podcast of how there's so many different levels, and where we're talking about is the carrier level, then we're even talking about the reassurance level. Let's talk about the agent level and how you created a product and a tool that's amazing for the end user, biased because I've used it, but in a way where it's like, it's so easy for the agents to utilize your tool, where you're providing them the support on the ground level to ultimately help the carrier.
Right, and I think it's important, listen, because obviously I have a hammer, so all my problems I see is a nail, and it's an insurance to value hammer. So I say, if you start from the agent level, the broker agent talking to their client, and they want to put together a comprehensive program. I don't know how you can put together a comprehensive program if you don't know what the values are. I'm not an agent or a broker, so I'm sure people have figured that part out. But I think that's helpful for the agent or broker. And in addition to understanding their client, understanding what's there for an exposure, I think it gives them a leg up in marketing that account. So as soon as the agent or broker has a really good handle on the account, I think that opens up more markets for them. And at the end of the day, and I worked at a carrier that used independent agents and brokers, they sometimes felt that those clients were theirs. And at the end of the day, it's the agents and the broker's client. And everybody at every carrier, that's what they want, is that client. And so that's where if you have a really good handle on it, I think that just follows along in the other parts of your agency or brokerage.
For sure. And we're sitting in beautiful Manhattan, New York City.
Yeah.
Can you share wisdom, like even the buildings behind us, right? How can we give experience and support to the agents when speaking about how they market and how they approach a area like New York City or these bigger cities with your valuation tool?
Well, I think probably the part of the marketplace with the biggest delta between what it should be and what it is on the commercial side. At the same time, the biggest price pressures are on the commercial side. Also, carriers are looking at the SME market, small, medium-sized market to grow, right? So it's all kind of a confluence of events around commercial properties. And I think where we help is, A, what is it, right? What are you insuring? And so people don't always know that. And so the idea of like, well, it's this building and all you have to do is plug in an address to start you down the process. I think it makes a broker look better to their client when they say, well, you have this building, it's worth this much, we think, in this marketplace. And then you can start the process with them. To me, again, hammer nail person, but if you start there, because that is what the policy is for. It's for that building. It's for that place, and you demonstrate some knowledge of it. I like that you mentioned we're in New York City. We're here at the Virgin Hotel, and this is the heart of the Midtown area. And just behind me, you see all the different variation of buildings out there. And I think that's the other part of this from the commercial standpoint. Like whoever writes the Empire State Building, I'm sure they don't write the whole thing. I'm sure they've layered that process in there. And even if they haven't layered that process, there are people that write the layers on the different commercial buildings. And so what happens if you're way off on the ITV, on that part of it, that first layer is always going to get punched through. So if you're writing the second layer and you think you're protected, you're not. And that's where you're always bumping through. And that's what we've seen on the commercial side, why with some different carriers that use us, they're really interested on that layering effect of it. So even though you don't have the whole building, that layer and how much you're charging for that layer is very important.
And from a consumer standpoint, like now even taking it a whole nother level is that, because I would imagine that consumers could be watching our podcast, especially if you have a individual that is responsible for the Empire State Building and those different departments, to say, well, I need to do my own research because that's ultimately their responsibility. Like what can someone do to ensure that their valuation is proper, where they know that, hey, I need to work with E2 Value, or I want to make sure the carrier is working with E2 Value because that's where ultimately I'm going to get the best valuation and I'm going to get the most accurate valuation?
Well, first of all, they should work with E2 Value. That makes it easier. Or use us at some level in the process. But we just had a client reach out to us last week because of the pressures on the pricing, and they wanted their underwriters to understand, how to use the tool and understand what they're getting into when they're writing the different policies. And so one of the things we did is I showed them, because we are in the time of AI, and I don't know if you knew that with Insure U2, which is an AI-driven tool. From a research standpoint, you just type in, I want to know the price of a commercial property, and I picked New York City, then I chose like Chicago or something. And the search engines, the AI search, bringing back the Copilot or whatever you're using, Claude or whatever, it will bring it back in pretty much the way that we look at valuation, the way that builders look at valuation. And it's interesting that AI is pretty smart. It does the look at what's out there, but it structures it in a way on its own that it can make sense of it, which is the way we look at it. It's the way of underwriting, broker, you can look at that marketplace. And again, we don't have a corner on the information. Like we think everybody should have this information. We want to democratize the information. What we have is a tool that takes that wide range of information and bring it down to one building. But it's amazing what you can get out of a quick search today, which before the AI search, it would take me, and I think I'm somewhat good at the searching of costs in a particular area, it might have taken 2 or 3 hours. Well, you can get that down to like 3 minutes.
I don't think that there would be another, maybe there's new companies that try to come into this space and try to help insurance organizations. But I mean, just share, you've been using artificial intelligence for years. It is not a new concept.
We didn't call it artificial intelligence back then, but one of the things that happens out in the marketplace is the availability of data. Right. So people want to make sure I know what this building is, and there's not a great correlation on the commercial side of how much data is available because of the intricacies of a commercial building. You have retail, apartments, condos, whatever, mixed use. So that the information is kind of lacking in that space. And so when we pull in the publicly available data that anybody can buy and pull it in, we don't have a corner on that part of the market either, but there's data missing. And so the key for us making it work, whether it was residential or commercial, is we used our data and information, mined it, which is now called AI, and then we fill in the blanks. And that's where we do the consistent and standardized approach. So again, even if our values aren't great, I think they are, but even if they aren't, everything's not great or great to the same level. So everything's consistently different from what people might say reality is or not. And so that consistency we provide that because of the ability to fill in those blanks. And that changes everything we think. So you put in an address, and sometimes you're not going to get an answer in every tool, but with us, you're going to get an answer more times than not from that process, and it will make sense from building to building.
What can or not necessarily the consumer do, but when there's information missing, how do we obtain that information? Why is the information missing? Where and what part of the process does that pick up and drop off?
Just so you know, there's missing information. There's incorrect information, right? The information that's out there's no such thing as perfect. A lot of people that got C's in school sit in a room and say, we want 100% answers. I'm like, well, that doesn't happen. So you got by on 75% answers. And look where you are. But it's there is information missing, and the way we have our database is structured with the data that we use the two base data providers for values, for property values and information in the U.S. And so if those two data providers don't have it, it does not exist in a publicly consumable way. So that gives you great information. For me, if someone has information that's helpful, but then you learn there is no information. So it just gives you that routing. Like I have the information, I'm gonna go this way. I don't have the information, and the answer is why. We were just at an InsurTech New York event in town. That's why we're in New York City. And they were talking about, again, to the bell curve. And so 80% of the time, you're gonna be in the middle of that bell curve. But why is something missing on that 20%, the 10 on each side? And that's where you want to spend your time. And so the AI and, technology and process can help you with that 80% of the time, so you can concentrate on those last two. But the answer is why there's no data. It could be that, like, if you're in the Hamptons, for example, they hide the owners. They're the Hamptons. And so there is a little bit of information there. The other thing could be it's a very rural community. So they haven't taken any technology into their tax valuation process. So they're just not going to have the data. The other thing, like parts of Wisconsin don't report the square footage. So it could be as simple as it's just the way they report data in that one particular spot. But that's an easy thing. Like, if it's just square footage, that's easy to overcome. If it's just this one little piece, those are things to overcome. But I think another thing which I think is important is, because we know what we're looking for, we can figure out if the AI is delivering what we're looking for. Right, we're looking for very specific information. And so if you're doing a general AI scrape, I had a meeting with somebody that said, oh, we'll get some AI to fill in that data. I'm like, whoa, well, that means magic, right? That's like magic. If AI is gonna fill in the data, it can fill in some data, but it has to have a basis in reality. I think that's what my partner and I, when we started, we had a basis in reality. We had an insurance reality, we had a construction background reality, and then we used technology to solve the problem of just getting coverage. And it's the same thing with really anything, the way we look at it. If you have some knowledge of what you're looking for, you can define what the search is going to be.
Is incredible, because it's almost like growing up, this was never going to be the end goal, where it's like you have the background in construction, you have the background in other exposures that ultimately help leverage and be an expert in this field, where in an insurance company, they have the actuaries and they understand the valuations, replacement cost, and ultimately what they pay out. But from boots on the ground, when we talk about a valuation is just an opinion, it's, well, what opinion do we want to go based off of? An expert or just an observer? And I think that.
Well, I think, which is surprising, and most agents, brokers, and underwriters will know that every insured, whether residential or commercial, has a cousin, brother, uncle who's in the construction industry, who is a construction expert and knows that that building cannot be that much money. The problem is a lot of times when there is a problem with that building, it turns out they're nowhere to be found. They want the insurance company to make the payment. The uncle just disappeared. And I said this was $2 million. It turned out to be $8 million. Well, come back and build it for $2 million. You were so sure way back then, and that's the piece where the folks who are writing the checks, they're deploying the capital to back up the things. They have a vote in this process too, where the uncle may not have a good vote and may or may not be useful at 5 years from now when your house burns down.
Just because the valuation is there, something that's important that we've spoken about is that you need someone to be able to actually do the work. And in certain areas, maybe it's licensing, maybe it's knowledge of the landscape and what's possible, resources. So I think that plays another role into it, is that not just anyone, you can't just grab your regular construction or your family member to someone to rebuild it, because certain things require expertise.
And I think we were out in Pebble. You were busy elsewhere, Craig. I want to make sure you run a multi-dimensional, multinational corporation there. But we were on a golf course, which is surprising in Pebble Beach, I know. And this one particular golf course, there are builders who are building around. They opened it up to build homes maybe 7-8 years ago. And there was only 2 builders. Like, they're only letting 2 builders in there. First of all, most important is the builder has the capability to do this $8 million, $10 million house. Second of all, they have the financial wherewithal to do that house. And so it's not just anybody can show up. It's the same thing like, from clothes you wear, shoes, everything is a sold good. Homes are a sold good. It's a retail thing. So it's a targeted market. And there's a reason that those homes cost that much. There's a reason why that home doesn't cost that much. Same thing with a commercial building. Not anybody can throw up a commercial building. We're in New York. Oh, my uncle can do that. But your uncle ever worked in New York City? No. Well, then probably not the person you want to do that, which goes back to the important part, we think, is the research about costs can only be in the area where the structure, house, building is. Like, what's going on in Atlanta is really important for Atlanta, but in no way shapes what's going on in New York City and vice versa, right? That's awesome. The price of lumber, people about lumber and all that stuff, doesn't matter if there's no one to put it in, right? So that's what drives costs. Local conditions are everything in real estate pricing, but also in replacement cost and repairing things and getting some of the capability to actually not mess it up.
100%. Like we say, is that liability doesn't just always cover fault, it covers legal defense to defend, where the same thing is that your replacement cost isn't just covering to repair the home, it's the cost to get someone and get those experts in there to get it done.
Right. And I can report, since we met last year, did this podcast last year right after the California fires, within 4 months, most of our clients had, and I'm going to say like 90% of their claims were paid, settled, the people could get on with their lives. And that's because, going back to your reason, why is it important to the agent or broker? Well, the other group is suing. They don't have anywhere near enough coverage. They're kind of trapped. They have a whole article, San Francisco Chronicle's been doing a lot of work around that, is that what's the fallout if you don't have enough? Well, can be, pardon the pun, but catastrophic after the catastrophe, and really ruin the financial backing of the commercial world, the financial life of a homeowner, and it can be even more devastating than the fire.
And how many claims, underinsured properties, does a company have to go through to realize that, hey, we have a problem?
I think one. One's enough, because it can be really far off. And I think that, but if you will see it, because you can never, talk about that, you can never catch up, right? You're always chasing rate, because it's not that the partial loss was excessive. It's that the coverage amount didn't reflect what's going to happen with the partial loss. And that's where those partial losses, like I said, with the commercial buildings, they punch through the layers. Well, those partial losses, you know, if it's a $3 million house and you're insuring it for $1 million, well, you're way off on that partial loss. I don't care how small it is. You're never going to collect enough rate to catch up with it. And partial losses are the story. I mean, I know total losses and fires get the headlines, but you know, that's just a small part of the whole world. It's those partial losses that drive it. So hailstorms, tornado storms, windstorms, you know, that's the type of thing that it's not a huge part of the world, but it's enough homes, it's enough commercial properties that can ruin an insurance company's day.
We're not looking at trying to solve the headlines. We're looking at the bottom 10, 15% that we can fix today by implementing and by working towards it. And that 10 to 15% over time is ultimately what adds up and solves bigger issues.
Well, that 5% is the tail that's wagging the dog. So we have valuation. We also have, for the residential side, we have what we call the structure insurance score, or SIS, and that's another way to find it. You don't have to use our valuation tool. The two run on separate tracks, parallel but separate tracks. But it helps, you know, people identify where they're missing the premium on their books, and that's really what this is all about. Where am I missing the premium? And you know, there's elephants and mice. And the elephants tend to hurt when they run you over. So we help you find, we call it the elephants in the grass, right? Because until you said, how many claims till I can find, if I have an insurance to value problem, it can be that one elephant in the grass that you stumbled upon. And it just takes that one loss to figure out, like, we have no idea why this is here and why that one's there.
So news, any updates? Marketplace
news, I think the one thing that's probably not going to get a lot of play, and it's really down in the weeds, but NAMIC, among other organizations, was working on removing a requirement that a Fannie Mae, Freddie Mac, FHA home had replacement cost insurance coverage. And so the farm bureaus and a few others felt that put the consumer at a disadvantage to have replacement cost coverage on maybe an older home and different pieces. And they wanted the ability to provide ACV, or actual cash value, so a depreciated value really comes into play in places where the market value is not that high. Maybe it's an older house or whatever, and needs to be fixed up. And so you can buy an actual cash value policy. The problem is, if you don't set the initial replacement cost value correct, just with everything, the ACV is not going to be helpful. If you're buying an ACV policy, back to the agent or broker, there's a lot of onus on the agent or broker to explain. The only thing Fannie, Freddie, and all they care about is that their mortgage is covered. So you have to have enough insurance to cover the mortgage amount. And once that's done, they do not care. And so you could own a piece of property with a burned out home or a burned out building, and that's all you own. And so you got to figure out how to rebuild your life after that process. And so I see it as a pretty good downside to some folks. But up until this point, there's been a pretty good downside. I mentioned the San Francisco Chronicle article. So there's enough underinsurance going on out there anyway that I'm not so sure this tilts it worse. But with flood coverage and the catastrophic things that happen, fire, depending which area, they're not going to cover fire, not going to cover flood. Flood you have to buy individually, like the houses in Houston a number of years ago when they had that big rain hurricane hit. Well, people just walked away, right? It was a $40,000 loss. They had no coverage for the flood loss. It's only $40,000, but they were just barely making the payments anyway, so they walked away. So Fannie, Freddie, they ended up owning a lot of homes in those areas that they had to fix up and take care of. And that's what the legislation was looked at, to make sure, and they have a thing about flood coverage, so that we as the U.S. taxpayer don't own a bunch of flooded out or burned out properties in that piece. And at the end of it, at the end of the day, is that consumer doesn't have the insurance, they're not put back financially, and they're not really able to recover after a disaster.
And then what's the point in paying for insurance?
Correct. Right.
Indemnification. It's a beautiful thing.
It is. I think that's on a bumper sticker.
Yeah. And news with each value, like innovation, forecasting. If we were to take a look at what to anticipate over the next 12 months until we shoot maybe another podcast.
Yeah, I think the we get pretty regular updates about, we have an inflation forecast for the year. That's how we do our inflation, is like what's happening over the next year of the policy, what's happening. We're getting a lot of emails with the price of oil, the inflation world, what's going on. And you get a lot of mixed messages out there, but inflation is here. It's still here. It never really went away. At the same time, things are going up in costs. There are fewer people who actually build homes because they're deporting folks that build homes. And it's really hitting the middle management, and I'll call it the middle management of the building industry, because the person who's maybe worked there 20 years knows how to speak different languages, knows how to get people brought in. So the laborers are still around, the people that can do the labor work, but they don't have the skill level. And that's really impacting the rebuild costs to the US. And so when you factor in oil and you factor in inflation, you factor in interest rates might rise again as opposed to be lowered because of the inflation, things are going to cost a lot more until the point where everything crashes. I always point out like that, what fixes inflation is a crash. I don't want a crash. I'm hoping we don't have a crash. But until that crash happens, things are going to be more expensive.
And is there anything that you think that from a insurance organization, agent level, like what is the most important information? If you could share advice and information right now, what message would you have to get across?
The real thing, when people talk about it, and we work with United Policyholders out of San Francisco, which is a consumer organization, it's not that they get a policy with all the bells and whistles. It's not that somebody spends their life savings on an insurance policy each year. It's that the consumer understands the impact of each decision. And you can't say, I understand, you can't say what's covered and what's not covered, because at the time of claim, it could be different, right? There's things that it looks clear cut, but at the time of claim, it may not be. But you can say, in the case of these covered losses, or in the case of this policy, this is how it responds. And so that the consumer understands the complete financial impact. And I think that's the problem. But we go back to, there are very few total losses. There are more partial losses. People tend to see it like insurance is just, I just need to cover this, I need to cover that. But realistically, if they had their eyes wide open with most decisions, I think, everything would be fine. As long as their eyes are open and they make a choice, they go, yeah, I'm going to undercover. Yeah, I'm okay with that. Hammering home what the policy is and cover it. And I think also, thinking selfishly, if I was an agent or a broker, people want to take your business from you all the time. Another agent broker is going to come along, they want to take the business. Commercially, they want to take the business from the stuff. And how they do it is they undercut the policy, right? It's easy enough to undercut. Maybe some policies aren't well done. But I think if you position it with your client up front, your expertise, your knowledge, it's harder for someone to pull that away, because then they're educated to that next person. What about this coverage? What about that situation? Where if you educated them and had them up front understanding what's going on, it makes it easier for you to keep that client.
Absolutely. And I think it's important for them to go through that valuation with the client and understand how that valuation is coming out, because at the end of the evaluation report, it's not just a number, right? It's a breakdown, it's wall height, it's square footage and quality, custom, basic. So I think it's important for agents to ultimately go through that with their client. Don't look at it just doing volume and just sell, because you want to protect the carrier that's ultimately allowing you to write business with them and give you that opportunity to do what they do.
I think the other part of that is I think people way under, have a way low deductible. I think the easiest way to save money is to have a higher deductible. And that is a key part of it, I think, to keep things affordable. And the other part of the education is you really never want to submit a claim. It's not in your interest to submit a claim, which is counterintuitive. I understand you're paying for insurance. I'm paying for insurance. I want it to respond if I have these problems. I said it's really better for catastrophic issues. If the roof gets blown off, yes, submit a claim, right? If there's like something big happens, but the little things. We just went through a very rough winter in the northeast where I am, and I know the northern part of the U.S. There's going to be tons of ice dam and water damage claims. And I think that, a good advice might be really think about it before you start putting in smaller claims for that.
Absolutely. And I think it's important to simulate a claim experience to understand, hey, you're paying for this policy because if something were to happen, this is the next action steps. I think that just to plug in, Rick Lindsay does an incredible job at like the simulating a claim experience and also how we met, and looking at it from a standpoint of that's ultimately how someone should be paying for a policy, is that, hey, I don't want the lowest price. I want to know what's going to happen, understand their options, and then pick their option based on that.
Yeah, and the important part of it, you brought up Rick Lindsay of Prime. If you're a trucking agent selling trucking insurance, you better be really good at selling trucking insurance. And you shouldn't sell, at least in my opinion, also sell a home policy. Same idea, like if you're a commercial writer and you understand a commercial line of business, and I'm not saying they can't have a little knowledge of the other pieces, but there's so much that can be a downside that you're not used to, right? Because you don't see it every day. And it's the same thing where, like, when you get in that claim situation, that's a great idea to simulate the claim. Like, oh, that's something I didn't see every day, so I want to kind of fix it.
For sure. And I think that even if they have a niche and they want to expand, using a tool like E2Value allows them to even probably step foot outside of what they're used to, because they can rely on more accurate information and a better system and a tool to ensure that they're doing something correctly, instead of going out of their wheelhouse and having zero direction guidance and ultimately the wrong valuation.
Right, and that's really the part of it is, and you talked about the policy, like all these other little things, there's things that are additional coverages, there's things that like the fire department response and all that, and that's a lot of stuff to be keeping ahead of, but that's why you have an agent or a broker, because they keep ahead of that stuff, and they should be.
Yeah.
The good ones are, I know you are, but understanding that policy. When I was a claim person, the first thing you did was pull out the policy. What did the policy say? I'm not so sure everybody does that today, but that's going to outline everything. We got in discussions with some folks about some of the schools that burned in California, and they were like, they got these different estimates in, and pretty wild estimates on school rebuilding. And I'm like, well, that's not what they built in 1965. That's what they're wanting to build in their wildest dreams, because you're an insurance company paying for it. But if the town had to raise taxes to pay for that school, it would not be that thing. Mm-hmm. But I don't know what your policy is, right? If you can tell me what your policy is going to put back, then I can give you some advice whether that you're going to pay that number or what I think is a more reasonable number. And that's an important part of the process for us, is what is your policy trying to cover? And then we can give you some advice on where the value should be in that goal, in that aim of what you're trying to get done.
True professional, expert, and ultimate pioneer inside the insurance space. I think that we really, really covered so much great information on this podcast. I'm excited for the next one. I'm excited to see the growth overall, and the changes inside the industry. And thank you so much, and I'm looking forward to it.
Well, right back at you, Craig, because I think what you're doing with Insure You Too, I think what you're doing with your podcast and the process, and I hope you take this in the way it's meant. You have a young, fresh, enthusiastic view of it, which I love. And that's just what that keeps us going every day, are people that want to be doing insurance the right way. And I think you bring that to the table, and I appreciate it.
Thank you so much, Todd.
Yeah. Take care.